Hi guys, welcome back to our accounts class where we are discussing AS15. This session we will try, target and complete this standard. So far I told you it's a complex standard, but you all told me you're understanding till now. Let's proceed. Okay. So previous session, if you see, what did we basically learn? We learned that if any payment is payable to employee post his retirement in a defined contribution planned or defined contribution obligation, we classified this as which one, guys? Post employee benefits. We split into two basically. I'm just getting a continuity here. Define contribution obligation, define benefit obligation, DCO, DBO. In defined contribution, it was easy because my work is only contribution and nothing after pass the entry for contribution. My work ended, correct? But in defined benefit plan alone, after contributing, I should also take care of benefit which comes after many years. So for that, what we did for that, guys, very simple. We basically tried to find out what could be the benefit in the future and started saving the present value of that today, and that was called current service cost, correct? That's all we did in last class, where I gave one illustration to understand the concept, and we did illustration number 9 in the study mat. We finished. Let's proceed a little further. So I'm going to write an equation. Tell me if you're understanding this. I will write in defined benefit obligation, A will be, or in other words, what is debited to my P&L or in my liability. First, I will write current service cost. In our example, the present value. B, we will add interest on A. Interest on above for that year, correct? Sir, I am not following. If you look at this, if you remember this sum, what we did over here, basically if you see, what did we do over here? In each year, we took opening balance, which is my current service, and added interest, and then current year's current service cost, correct? So debit to P&L is two things. One is interest for current year, one is current service cost of current year. Are you following? Are you all understanding, guys? Now let's go back to our 5,000 rupees example that we took. Okay, to understand this, if you look at the 5,000 rupees example over here, okay, you remember this example, guys, over here, where if you invest, or in other words, if you have an amount of current service cost of how much, guys? This much in each of these years, then you will end up saving 25,000 at the end of 5 years. How do you cross check this? How do I cross check this? Meaning, how do I check if my answer in year 3 is 12,396, correct or wrong? Okay. Look at this. So nice it is. End of third year, what we got, guys? Year 3 end, we got 12,000. How much? 396, correct? Year 3 ending, we got 12,396. That means my savings, or in other words, the provision that I should have created at year 3 ending is 12,396, which we computed using this table by doing this 3 times this table. Lengthy table, I can't do it always. How do I check if this 12,396 is correct? By end of 3 years, I should have saved 5,000 into 3, 15,000 rupees, correct? The present value of this. End of 3 years, the present value of 15,000 rupees at the end of year 3. End of year 3, How many years are still left? 2 years. That means I have to discount by 2 more years. The end of 3 years, I should have saved the present value of 15,000. So how to quickly check in exam if my table is correct? I will just do 15,000 into 1 divided by 1.10 to the power 2 for 2 years. How much you get? Into 0.8. 826. How much are you getting? 12,396. That means that full table is not needed. I can quickly compute whichever I want, whichever year I want easily. Are you getting the logic, guys? How to do for year 4, sir? For anything. Okay. Let me take different sum. Okay. Let me take a different sum. I want to know in year 3, the closing balance in provision should be 15,43,094. How do I check without the table? Okay. In year 3, how much you wanted, guys? 15,43,094. This much should have been created as a provision. That means for this much amount, I should have passed already P&L account debit to provision over the last 3 years. So I would have reached this. This is nothing but savings or provision of 3 years, 6 lakhs each year. 6 lakhs each year. That means can I say 18 lakhs present value is 15 lakh 43,094. That means in 2 years from now, after 2 years, this should become 18 lakhs if I compound, correct? Are you getting it? So now if I do 15 lakh, not 15 lakh, sorry, 18 lakhs into 1 divided by 1.08. Here this sum it was 8% to the power of 2. How much are you getting? 15 lakh 43,094. That means table not needed, guys. Round off. 5-10 rupees difference, you leave it. Are you getting that, guys? Are you understanding? So I can cross check easily in exam. You don't have to wait till you go to 5th year, 30 lakhs coming up. Each year I can cross check. Are you understanding? Now let's keep this example in mind, this beautiful example where 6 lakhs plus 6 lakhs plus 6 lakhs, 18 lakhs into 1 divided by 1.08 to the power 2 gives me 15 lakh 43,094. Now I am introducing the next concept. Follow carefully. This is still year 3. What is the guarantee that every year my salary will be 6 lakhs? It can increase. Why will it be 6 lakhs for all the 5 years? Promotion. Well, I want to get promotion, guys. So if I get promotion in the 4th year, I'm giving example. See, in this question that we are doing, already promotion is included only, we have got 6 lakhs. 10% we added. So it's already included. I'm assuming if that's not that, if everything is fixed or for whatever reason, salary is changed. He went to a different role. Now, let's say for example, I'm just using this illustration as my base for next concept. Don't go question the facts in that question. Are you understanding, guys? Now, let's say suddenly in 4th year, I have been debiting 6 lakhs each year. No, I have been debiting what each year as current service cost? I have been debiting how much as current service cost, guys? 4 lakh 41, 4 lakh 76 400, 5 lakh 14 400. The total of that only we get 15 lakh 43,094. Correct? This is correct, guys. Check if you want. 4 lakh 41,000 plus 4 lakh 41,000 plus how much, guys? 4 lakh 76 400 plus 5 lakh 14,200. You are getting how much? 15. Interest. You add this year interest also. 76,214. 76,214 plus 5 lakh 14,200 plus 476 plus 441. My total provision is 1543 094 at year 3 end. Are you understanding till here, guys? Now I am telling you, in year 4, the salary has become 8 lakhs instead of 6. Correct? Can I go change what I debited already in the past? Now this is a change in salary for whatever reason. This impact should come in current year. So if my salary is 4 lakhs, the gratuity payable, will it be 6 lakhs into 3 plus 8 lakhs into 2, or will it be 8 lakhs into 5? 8 lakhs into 5. Last drawn salary. Last drawn salary. It's not a different. Last drawn salary is 8 lakhs. So it will become 8 lakhs into 5. That means, follow, in year 4 ending, my provision now should be, how you got 1543,094? How you got 6 lakh plus 6 lakh plus 6 lakh, and you did present value? That means in year 4, can I say my present value should be 8 lakh plus 8 lakh plus 8 lakh plus 8 lakh, how much? 32 lakhs into 1 divided by 1.08 to the power 1. Why? Now I am in year 4. Only one more year left. Correct? So how much are you getting? 29 lakh 963. This is for year 4. Now imagine this happened in year 3 instead of year 4. I want you to compute. If it happened in year 3, what you will do? 8 lakh plus 8 lakh plus 8 lakh, 8, 16, 24 lakh into 1 divided by 0.8 to the power 2 for next 2 more years. How much you will get? 20 lakh 600. Now I am going to make a statement. 613. I am going to make a statement. Tell me if it's correct. If my salary is 6 lakhs every year, at the end of year 3, the provision should be 15 lakhs 43,094. Correct? If my salary is 8 lakhs every year, at the end of year 3, my provision should be 20 lakh 57,613. Are you following? Getting it? Are you following? Sure. Forget this year 4. I just wanted you to compute if anything different comes. You understood how to compute. All these years I have been doing this. So at the end of year 3, I actually now have 15 lakh 43,094 because I thought my salary is 6 lakhs. Now suddenly in third year, the company said your salary is 8 lakhs. That means my provision now should now become 20 lakh 57,613. So a provision which is 1543,094 should now be 2057. This correction, additional debit I should do in this year. Correct? How much is that? 1543,093 to 2057,613 is how much? 5 lakh 14,520. Are you following, guys? So now follow very carefully. How did you get 1543,094? Let me write down. 1543,094 was breakup of all these things. So which is nothing but, let me write all of those things. 4,41,000 plus 4,76,400, or in other words, if I have to write this, can I write this as interest plus current service cost? Correct? It is nothing but interest plus current service cost up to year 3 and correct? Second year? It's already included here, no? We have to add interest of second year also. Correct. That means it's the total interest I have to consider till now. Correct. So basically I have to add all of this, if I add all of this, then you will get 15 lakh 43,094, correct? Add all of this. Let me write all the values here. 4,41,000, 4,76,400 plus 5,14,000 plus 35 plus 76. Guys, are you understanding? Let me repeat again for clarity for everybody. Year 3 end provision is equal to this, based on what we already did before the previous session. If it is now at 8 lakhs, which you just recomputed, it should be 20 lakh 57,061. So apart from this, I have to now additionally debit how much, guys? Which we computed 5 lakh 14,000. Now what does this represent? What I should have debited in the past, I didn't debit in the past, because in the past I thought my salary is, now because my salary is changed to 8 lakhs, I am additionally debiting now 5 lakh 14,520, something which belongs to the past. I am making adjustment in the present. So can I say my total debit to reach 20 lakh 57,613, my total debit to reach this is current service cost plus interest plus past service cost, correct? Look at this. 4,41,000, 4,76,400 plus 5,14,200 is the current service cost of each of the respective years. 35,280 and 76,214 is the interest of each of the respective years. If there is a change in salary, you might have to do another additional debit so that you reach 20,57,613. Are you following, guys? So now go to my formula or table which we made. Now look at this. Before the break I told you will add all these things, which is nothing but opening provision plus interest plus current service cost. In certain cases you will also add past service cost, cumulative balance of all the years put together, 5,14,520. Are you getting? 5,14,520 put together. Are you understanding, guys? But is this correct? You are debiting 3 years expense in 1 year. So what he is saying, this will be for the time being, I will add it, I have to add it, because my closing provision has to be 20,57,613. How I will write the entry for this? Follow very carefully. How I will write entry for 4,41,000? I will write current service cost account debit 4,41,000 to provision, correct? Correct. How I will write entry for 35,280 interest? I will write interest or finance cost account debit, how much? 35,280 to provision, interest expense. Okay, I am debiting, it's increasing, provision. So like this, if I keep passing entry in year 1, year 2, year 3, only then I reached 20,57,613. Yes, this year I have to now additionally in year 3 debit what, guys? 5,14,520. So my entry will be past service cost account debit to provision, how much? 5,14,000 to same thing, 5,14,520 Only if I pass this entry, my total provision will reach 20 lakh 57,613. Are you following this, guys? That is why I am debiting here past service cost cumulatively. Are you following? But the standard has something a little illogical. We don't have a sum. Ind AS has slightly different. I don't want to confuse you much. What they are saying is basically, by debiting so much amount in same year, you are not following accrual. 3 years expense debited in the same year, correct? So therefore what he is saying, instead of passing this entry is passed for what purpose? To make my provision. How much? 20 lakh 57. That is fixed, because that should be the provision today. Then only after 5 years, 8 times 40, I will get 40 lakhs. Otherwise it won't meet. So 2 provision will remain as it is. 5 lakh 14 520. But this belongs to how many years? I will split this, divide by 3. How much is for 1 year? Past service cost account debit 1 lakh 507. Rest I will take as prepaid. I will take it as a prepaid, amortized, prepaid service cost for 2. This entry I am passing in year 3. See, same entry, guys. If you look closely, let me just align the screen. Same entry both, correct? In the previous entry I am debiting fully in this year, and now I am debiting only 1 year cost. Balance I am transferring to next year. What is this amount, guys? 3,43,000 013. Next year I will reverse this. How I will reverse? I will debit my past service cost, account debit 1 lakh 71 507 by debiting P&L. I have to debit what, guys? P&L. Can I credit provision? No, you already credit provision. So I have to reverse now what, guys? Prepaid. Prepaid service cost 1 lakh 71 507. By doing this, what is happening? My provision is reaching its goal in year 3 itself, but my debit to P&L is spreading over 3 years of year 3, year 4, year 5. Can you see the beauty of accounting, guys? Are you getting it? What we are doing? Hello, we don't have a sum like this in book, but you need to understand this for past service cost. So in simple, what is past service cost? If suddenly the salary or anything changes, factual change, not an estimated change, really the payment changed or payment terms changed, instead of 15 by 26 became 1 by 3 or 2 by 5, then an actual change has to be adjusted as a plus or minus in the form of past service cost. Past service cost will come if it's a plus. It can decrease. If it decreases, it's called, no, not benefits. Leave that, it will come if it changes. It will come within this only. It will come, if it changes, it comes in curtailment, guys. Okay, if it changes, it is called gain on curtailment. Gain on curtailment means reversal. Now it's increasing, there it is decreasing, so you will minus it. Why it's, I am not showing here, I am only showing net amount. This is liability side, guys. This is the liability. Here I am showing amount debited to P&L. Now look at this. Current service cost, current year amortized, plus past service cost, vested plus unvested amortized, minus gain on curtailment, plus or minus. Whatever gain or loss comes will spread over 3 years. Are you following, guys? Clear? I will come back to this equation little later. This part you are understanding. Everybody clear? Now 5 years over. My provision after 5 years is, in our example, one example 25,000, one example 6 5s, 30 lakhs. Now 8 into 5, 40. Maximum scenarios we saw. Now after 5 years we will pay up. What is the entry? Let's say I paid this amount. What is the entry for payment? I won't debit P&L. Already debited. Liability created. Provision account debit to bank. It could be 25,000, could be 30 lakhs, could be 40, could be plus or minus also. It may not, it's estimate guys. We did estimate. Could be more, could be less. Whatever difference comes, debit to P&L. Are you understanding guys? Clear? Huh? Following. This what I am paying him is called what? What I am paying the employee is called what? This plan is called what? Defined benefit plan or defined benefit obligation. So this money paying to him is called benefit paid to him. That's why from the overall liability I am reducing benefit. See, until point 4 is creating provision. Point 5 I am reducing benefit. That means point 7 should become 0. It's like all these three together became 30 lakhs. Now I am paying 30 lakhs. So now it's becoming 0. End of the period. Are you following guys? Understanding of? Now apart from this, what am I discussing? Sir, we just did 6 lakhs, 6 lakhs, 6 lakhs every year. If it changes, such a change should also be increasing or decreasing. Such a change could happen for reasons like salary change, this change, that change. Clear? Now this whole thing is an estimate. Whose estimate? Actuarial estimate. So because it's an actuarial estimate, actuary itself can change the estimates every year. So that change also plus or minus I will change in actuarial assumptions. As change in actuarial assumptions. Sir, what is the difference? There is a very nice conceptual difference between past service cost and change in actuarial estimates. What is the difference? In past service cost, it's a factual change. It's an actual change. Because salary increased, because some terms changed. Actuarial estimate, it's an estimated change. I'll give an example. Past service cost change could be increase of salary. Actuarial estimate could be change of discounting rate. Are you getting it guys? Both leads to the same impact, plus or minus in my provision. Do the adjustment just like what we did now. Are you getting it guys? It's an estimate now, I will take it to point, change in estimate, otherwise past service cost. That means, can I say, now we will get one holistic view. Look at this. The total closing balance of provision at end of any year is nothing but, because this will never become 0, because year 1 employee will be paid in year 5, year 2 employee will be paid in year 6. So every year provision will keep increasing, benefits will keep decreasing. It will be a continuous ledger unless company closes down. Are you following guys? Or unless all the employees resign. So now look at this whole formula. The thing is, I will first start off with current service cost. This equation you will get logic now, which is nothing but, in simple words, present value of future what I have to pay plus interest on this, because only then it will become future value of, plus past service cost, which is nothing but any changes from what you have already done over here, rectification for that, plus or minus, minus benefits paid. This is like creating a provision for tax and then settling the tax. So creating provision for gratuity, benefits paid means gratuity paid. Again plus or minus actuarial change. This closing will be this one. Getting logic of? Now which will mandatory be there in every sum? Current service cost, interest. The remaining 3 depends on the question. May be there, may not be there. There is much more detailed discussion for this. This itself is a lot for inter. We don't have many sums over here. We have very, very basic sums where they are giving you what is past service cost. But even if they don't give you, we learned how to compute now. That shortcut, without doing that table, we found how to find this. That means without any of this, I can find this. Correct? So in exam, you know how they will actually give. What they'll actually do in exam, if they are smart, this we can easily find. This you can find, this you can find. He will give you right hand side. He will give you few values in left hand side. This will be balancing figure. Because all this equation I did the right hand side, correct? Left hand side we have to do, we will find what you are not able to find or data is not there. Take it as balancing figure, because the end goal, I need this. The closing provision should match with whatever is the salary for that year. Are you understanding, guys? Getting it, everybody? In other words, this 5,14,520 which you found and told me was a balancing figure, which was past service cost. You never computed 5,14,520. How to compute 5,14,520 if you have to compute 8 lakhs minus 6 lakhs into 1 divided by 1.08 to the power 2. 2 what? 2, correct? Are you getting it, guys? 2 lakhs into, how, not 2 lakhs, 2 lakhs into how many years? 3 years, correct? 2 lakhs into 3 years into 1 divided by 1.08 to the power 2, correct? I never computed that time, I didn't want to confuse you. Let me again repeat. 5,14,520 was a balancing figure. But why that balancing figure came? Because my salary increased from 6 to 8. So my increase in salary is 2 lakhs for how many years? 3 years into 1 divided by 1.08 to the power 2. 2 more years left. You will get the same 5,14,000. Are you getting it, guys? Are you genuinely understanding? So either you can compute or take it as a balancing figure. Both are fine. Are you all genuinely understanding? Hello? See, this part is that complex part, guys. I'm doing the whole thing step by step, taking a lot of time. Are you getting it? Okay. Anybody has any doubt till here? Online, Padmanabham, just now I'm seeing. Oh, he's been asking doubt from morning, sorry. Sir, why will company give doubt related to morning class or previous session for recording? Why will company give salary for days employee is not working? Sunday you are not working. Why you are getting salary? That's a paid leave. Then will you work all 7 days, Padmanabham? Will you work Monday to Sunday? Working days means Monday to Friday. Don't tell, sir, class I'm coming all days, sir. Monday to Sunday. When you start working, Sunday you will be mandatory leave. But you will get paid for that. That's a paid leave. Are you following, guys? Or beyond Sunday, some festivals and all will be leave. Are you going to work on Diwali, Padmanabham? Come on. Sorry, Padma. Okay. Fine. Clear? Yes, he said no. Doubt clear. Yes, fine. Sorry, he's been asking from morning, guys. Now only, same doubt he's copy pasting in different language. Now only I'm seeing. Please feel free to ask the doubts. Everybody who's watching online. Recording, you know, you can WhatsApp and get the doubts cleared if you have anything. Clear? Done, guys. With this dabba is done for me. Now only I have to go to the asset side dabba. In that we have 3 sums. Will the liabilities match with the asset? That means will I exactly invest the provision in assets? See, why you are creating provision? In all these sums you create provision, for example here 20 lakhs something, correct? That will be invested this side by passing asset to cash. Are you following, guys? Everybody, we are almost towards the end, guys. Another 40 minutes. So asset side is a separate concept. Will my asset and liability be equal every year? First year maybe it's equal, because first year in the previous sum, for example, if you take previous sum, if you take the table, first year I invested 4,41,000, correct? So what I will do, in liability side I will have provision 4,41,000. Here I will have investment in some securities. Correct. What I will pass? Investment to bank. Correct. The reason why I am creating provision is that after 5 years I have to repay. How I will repay? Only if I can create this asset. That's why I told you in the very first class, depreciation is a saving. Non-cash expense is a saving. This is a non-cash expense, leads to a saving if you use that cash and invest. Do you remember first class I told depreciation is a saving. So here if you debit, then the cash will be saved. I am putting it into approved investments as per AS 15. Now my question is, every year will this provision be equal to investment? No. Provision is what I have to save. But the investment value can keep going up and down based on market. Correct? So of course, the asset side and liability side may not be the same. There will be a difference. How the asset will increase? Give me an example. How this investment? Asset means you can't buy car, guys, over here. I'm not giving employee car. I need to give him what? Cash. So I will invest in securities. When he is leaving, I will sell that security, give him cash. Now how these investments will go up and come down? Think of AS 13. No, just how it will go up and come down? Normally, interest, market value fluctuation. Market price goes up, it will go up. Market price comes down, it will come down. I am receiving interest up and down. Are you following? Now how to value these assets? AS 13, short term or long term? Short term means cost or fair value, whichever is less. Long term means keep at cost other than temporary. We studied in AS 13. What to keep? Value. If I keep this at cost, now look at this. If I keep this at cost and if I keep this at provision, provision will keep increasing every year. Cost will remain the same. Then when somebody looking at this in 4th year will see such a big provision and see cost is less, they will tell, hey, you didn't invest the money. But actually you invested, this also would have gone up because of fair value. That's why, see, if this side interest you are adding, it goes up by 8%, goes up by 10%. This investment also will go up. That means both should balance up. So the standard beautifully comes out and tells, don't value at cost, doesn't make sense. Don't value at cost or fair value, whichever is lower. That is applicable if my investment is short term, if my intention is to sell immediately. Correct? Then what to do, sir? This also, if you won't allow, then what to do? The standard tells beautifully in all the 29 accounting standards or 32, including everything we have in syllabus. 32 totally, remove all the exclusions. This is the only place where investments should be valued only at fair value. Only place in our syllabus where the Ind AS tells many things. Leave that. In our inter syllabus, this is the only place where investments in case of employee benefits for a defined benefit plan should be valued at. I want the logic. I told you why it's not cost, why it's not cost or fair value, whichever is less, why it's fair value. It has to match with my provision. Only if I take this at fair value, I can compare with my provision and see, are they similar? This much money I need, do I have that much money? Are you following, guys? Are you understanding logic? So, my investment, first after you invest, every year this value will change, go up because of interest income and go up and come down because of fair value changes. Are you getting it? It could be beginning of the year my investment is 100. End of the year my investment is 130. The excess 30 is because of something, it's a return for me, correct? Are you following? So in questions you will get, they will give you 100, they will give you 130, they will ask you what is 30. What is that? Return. In this we have 3 sums in study mat. We are going to do all 3 very easy ones. Now look at the asset side, guys. There are still few more things, but I'm just talking about a few small things. Okay, before I go to the table, how will this 130 reduce? Increase, I told. 130 will reduce if fair value drops. Give me one more reason why this investment will drop. Think logically. I am selling. Why I will sell? Because I have to pay. 5 years over. How long I will keep it? I will keep it until the employee leaves. Employee resigned and left. I have to pay him benefits. What's the entry for paying benefits, sir? First I have to sell. Bank account debit to investment. Then provision to bank. Bank cancel. Asset side investment cancel. Liability side provision cancel. Correct? So this can also drop if the benefits are paid, defined benefit obligation, if you meet the obligation. Are you getting it, guys? So now come here, look at all of this. How the asset will change? It's basic common sense. First, it's how much you invest. Then it can go up because you earned interest, correct? Then it can reduce because benefits are. Then come to point 5. It can go up and come down because of changes, actual return. Changes in return, going up and coming down. That return balancing figure, correct? What is contribution made? Current year investment. What is contribution made? See, opening is 100. Current year I could have made 50. So in simple, my investment is 100. It can go up because of interest. It can go up or come down because of fair value changes. It can come down because benefits are repaid. Again, it can go up because you made additional contribution. If you include all of this, you will find closing balance. Are you following, guys? How we will give an exam? In these 5 things, 6. Very easy. Are you mugging up? It's logic. Balance can go up because of interest, contribution or fair value. It can come down because of the benefits or fair value. In these 5, that fellow will give 4. Which 4? Any 4. Who should find the 5th? You should find. Are you getting it, guys? With this background, let's go do the sum where you have to find that missing figure. Okay, that's it. After this, illustrations. Nothing new in chapter, guys. This is the core concept. Let's straight away go and do sums. I will tell you exactly which sum. Yeah, go to practical questions. Number 2. From now it's easy, guys. If you are somebody who understood logic, quickly you will finish 2 minutes and now you will hope AS15 comes in exam. Look at this question. Following data apply to X Limited. Defined benefit, pension. All sums are defined benefit sums. Which method is this? PU, CM. What is the full form? Projected unit credit method. Okay. Why is it each unit of salary we are projecting for the future and accounting now? For the year ended, calculate the actual return on plan assets. Let me prepare like a ledger. What was the opening value of assets? 11 lakh 40. Let me prepare like a ledger, guys. Think asset is debit. Opening value 8 lakhs. See, recording students, I didn't tell 11 lakh 40. Whenever students repeat, I will just tell what they tell. Blindly, I do that many times. Okay. So, I generally don't apply. I trust you guys. Same way like someone told here, Radharam, he told Radharam told us, guys. So, that's why recording students, don't look at me like that. Okay. Now, so what is the opening value of asset? 8 lakhs. Rahul corrected us, guys, recording students. Okay. Closing value is 11 lakh 40. Now tell me, benefits paid will come which side? It decreases the asset or increase the asset? Decrease the asset. So it comes on my credit side. Asset is decreasing, correct? Sir, ledger mandatory. You can do statement also. I'm just trying to make it more easy. Contribution, employer contribution, how much? 2 lakh 80. Which comes on the debit side. Asset is increasing plus 2 lakh 80. Ledger is tallying up. No, there will be a difference. Find which side difference. 2,60,000, which side? Here, debit side. So you are saying difference is coming here. That means asset increased by 2,60,000, which is nothing but my actual return. It could be interest, it could be fair value, we don't know. We can't tell clearly. It can be combination of interest and fair value. We don't care about that. Go down. Answer is 2,60,000. 4 marks done. Or maybe in MCQ. Easy, guys. Following up. Then question number. Now we are going to do 3 sums like this. But why this much time? To understand these terms. Otherwise, sir, I am not understanding, sir. Mug up this dabba. Which comes where? Go apply it. You will still get the marks. Examiner won't know if you know logic or not. Okay. But I don't think you need to mug up your understanding. Let's check in the next sum. I will tell you which sum. Super. Go to the last sum. Last sum in additional questions. Question number 3. Anupam. That's question number what, guys, for you? Pavitra, tell me. Question 12 in one of the books. ICA study mat. Question number 9. So ICA practical, it's question number 9. If you are watching the other book, you have question 12, or this book means question 3. By now you should have known the drill, guys. Last topic you are seeing. You know where to find this. Okay. Everybody with me, guys? Hello. Look at this question. Easy, but just 1-2 extra points will be there. The fair value of the planned assets. This investment is called not investment. It's called plan asset. Defined benefit plan assets. That plans asset. Okay. Defined benefit plan assets. Was 2 lakh in respect of employee benefit pension plan on 1st April. Opening balances. Like this, we have 2 sums. This sum allow me to do. You participate. Next sum fully you do. Inside illustration, we have a similar sum. Okay. 2 lakhs on 1st April. So opening balances. Let me prepare ledger. Say I am preparing ledger. You can prepare statement. Both are fine. Statement is more sensible because this is not a ledger. Okay. Opening is. Okay. Let me do this name in statement itself, guys. Okay. Particulars. Opening balance. 2 lakhs. On September 30th, plan paid out benefits of 25,000 and received inward contribution of 55. So I will do minus plus how much? Plus 55,000. Are you following, guys? On 31st March, the fair value of the plan asset was 3 lakhs. So the closing balance, this I will put in bracket. On 1st April, company made the following estimates based on its market study. Company means actuary. Actuary made the estimates. Interest and dividend income that we should have received is 10.25%. Add some realized gains minus some admin cost. Expected rate of return is 10.25. Now this difference, what you already found the difference before I did. How much you got? That is return. Now this is not the answer because this is actual return that you may have gotten, but these guys are expecting how much? 10.25. So actual is how much? 70,000. Come down, let's check. Actual is 70, it's correct. So we did the same thing. 3 lakh minus 2 plus 55, same thing we did, we got 70, here also 70. So this what you computed now is called actually what we got. But in life, what you expect and what you actually get, are they the same, guys? Anybody? Yes, sir, whatever I expect, everything I'm getting in life, my life is like that. Okay. So it's not humanly possible, not because your expectations are like that. I studied for 1 month, I want rank, or leave studies, guys. Anything you expect more. I'll put 5 reels, I want 1 million followers. No. Okay. So here also in defined benefit, follow guys, what they are saying, what you actually got is 70,000, but what was expected was 10.25%. Can you find, they are asking, compute the expected returns. Where is the question guys? Where is the question? So this is solution. Question ends there. Where is that? In the book it's there, it's not printed here. So I've seen the question. So the question is calculate expected return and actual return. Otherwise there is no question here. We are simply solving. Okay. So calculate expected and actual. Actual we found out. How to find expected? How to find expected? My expected will basically be, I'll do for this sum. Opening balance is, opening is 2 lakhs. During the year additions is plus 55 minus 25,000. So net increase is 30. I can't add 2 lakh 30 because this is there from opening for next 12 months. This is opening balance. Look at this carefully. This benefits and contribution came on which day? 30th September. So only middle of the year. Correct? Common mistake we will do is, sir, opening is 2 lakhs, sir, plus 30,000. So 2 lakh 30,000 multiplied by 10.25%. Here 30,000 is there only for 6 months. So now you do the same thing guys. 2 lakhs into 10.25%. Why 10.25? He is given it. How to find? Okay. How much are you getting? 20,000. Next 30,000 into 30,000 no? Into 10.25% into how much? 153 1,538. Okay. How much are you getting? 22,038. This answer is 100% correct. Book answer is not correct. They would have got 22,000. I will tell you why. I will tell you what they did. Okay. I will tell you what they did. I will tell you when that answer is also correct. This answer is spot on correct. I can guarantee you that. I will tell you what those fellows did. Okay. 2 lakhs into 10.25 is how much? 2,500. Now, which is there for the whole year. Now, this 30,000 is there only for 6 months. Look what they have done. They have done compounded every 6 months. They use compound interest. What is compound interest? What we did here is simple interest. What is simple interest? This whole interest is only on principal. That means today if I have 100 rupees, interest is 10 rupees, total 110. What he is doing, 100 plus 1 day's interest, 101, again into 10%, you get answer. Interest on interest, interest on interest, interest on interest, that is what? Compound interest. During 6 months, he found 1,500. How did he do that? Follow. During the year for 6 months. So how do you find compound interest rate, guys? Whole? This matched, correct? Yeah, 20,500. Only for 6 months they used compound interest. That means, how do you find compound interest? Now look at this. The same sum we have in the inside study mat. Illustration 7. where he would have given, look at this, alternatively, same sum, you are going to do it now. Alternatively, the above question may be solved without giving compound effect to rate of interest. So they have done using compound interest. Compound interest you would have seen in FM, foundation time value of money. How do you do compound interest, guys? P is equal to A into 1 plus R to the power N. So here this 1 plus R to the power N is given at 10.25% for the whole year. You need to reverse work and find 6 months. How will you do that? Principal is equal to how do you do that compound interest, guys, that computation? Where is that? Yeah. So we have 30,000. Amount is 30,000 into 1 plus rate is what? 10.25 percentage to the power of half a year, 1 by 2. 1 by 2 becomes R divided by 1 plus, here also formula comes, correct? Divided by 2. On numerator, do you get something? No. One second, tell me. 1 plus 10.25 divided by 2. 1 plus 10.25 percentage. So R is equal to, you will do the other working, correct? Okay. No, just tell me the formula for compound interest, guys. Yes, Ashwin online. Oh, I got formula. Yes, he has done it using effective interest formula. So 1 plus I to the power n minus 1. So he has done 1 plus 0.1025 to the power half minus 1. How do you do this in calculator? He is multiplying, this will become is equal to 0.05 is equal to 5%. Square root of half, are you able to do it, guys? That's it. So you get effective interest 5%. Actually, this is a final question. In final book, it is there. This you studied in foundation, time value of money. Should I do this in exam? No. Why? Don't do compounding unless question mentions compounding. That's why over here, in the same question, in sum number 7, he would have mentioned below alternatively can be done without compound using simple interest. Are you following? This Ashwin X wrote down. This do you guys remember learning? See, there is nothing for me to teach here. It's compounding interest formula. 1 plus I to the power n minus 1. Here I stands for interest. So interest by 100 is nothing but 0.1025 to the power half. So 1 plus this will become 1.1025 to the power half. So you should do square root. So you just type in calculator 1 plus 1025 square root minus 1, you get 0.05 into 100, 5%. So you have to remember this formula. This is the formula for finding effective interest rate. Are you getting, guys? 5%. I am not teaching you this, guys. I am not deriving the formula. It's basically, how many of who remembers? Online one doubt. Santosh is asking, sir, should we consider all the 5 years or in all the sums? Should I consider only 5 years for computing gratuity? No. Question will specify If question is silent, then take 5. Guys, following guys. Now with this background, can you quickly try illustration 7 inside the chapter? Inside the chapter illustration 7. Finished. Vignesh already finished guys. Illustration 7. What is the actual return here? Opening is 1 lakh minus 19 plus 49, again minus 1 lakh 50. Then this actual loss also to adjust the 600. No, actual loss on obligations. No, this will not come. This is on the liability side. Where will actual loss come, guys? It comes in provision on the liability side. So you get answer as 21. All of you got this? How to find expected return? Same thing. Here also they use for what? That same compound interest, and they found if you don't do compound interest, our answer will be 1 lakh into 10.25% plus 30,000 into 10.25% into 6 by 12. How much? 1538 plus 10,250. 11,788. Are you following, guys? If you ask me, simple interest is the correct thing. Why? Anywhere in question he mentioned compound interest. Actually what happened, this question is from CA final book. There they mentioned use compound interest. So from final book they copied the question and the answer, but forgot to add the word compound. But that's why later they would have added this note, alternatively do without compound. For exam, my suggestion will be do it in simple interest if question is silent. Only if question uses the word compound, you use this formula what I just wrote here. I am not doing derivation of this, guys. Compound interest. Clear, guys? Done. Now let's do all the balance illustrations one by one. Let's come from the first and close this chapter, guys. That's it. It's over. We just have to practice a few sums. 1 is over. 2, 3, 4, 5 is done. 6. I think 2, 3 sums are left in MCQ. That's it. We can close AS 15. That's all. Sir, should I practice more sums for the standard? What is there in the book? You be clear. That's enough. Either they will ask that reverse discounting 4, 3, 2, 1, or they will ask this actual or expected return for initial few attempts. That's it. Omega Limited belongs to engineering industry. Company received on actuarial valuation for the first time for its pension scheme, which revealed a surplus of 6 lakhs. It wants to spread the same over the next 2 years. So it received a surplus of 6. What is the surplus? Received an actual valuation and pension scheme surplus of 6. That means the closing provision or something is 6 extra. It wants to spread the same over the 2 years by reducing the annual contribution to 2 lakhs instead of 5 lakhs. The average remaining life of employees estimated to be 6. You are required to compute on the viewpoint on finalization. Note on mandatory accounting standards AS 15. What are they asking in question? No, what to advise? Regarding what? Received an actuarial valuation. So, actuarial valuation means valuation of the provision. In liability side, actuary is valuing the closing provision. The closing provision has revealed a surplus of 6. That means I have to reduce it. This is that. Change or, look at this, changes in actuarial assumptions. That will keep changing. So this impact you have to change in my liability side of provisions. They are saying, instead of doing it right away, I will amortize it or I will spread. Can they do that? Amortization allowed only for past service cost because it's an actual. Because it's an actual, you are allowed to amortize. This itself is an estimate. We studied an estimate. Full estimate should be difference should be made immediately. Imagine provision on debtors, 10% becomes 20%. Can I tell I will do 5 this year, next year 5? No. Are you getting it, guys? So this full 6 lakhs should be accounted in the same year, or in other words, amortization is allowed only for past service cost. Are you getting it, guys? Come down. Actual gains or losses should be recognized immediately in the statement of P&L. Amount of 6 lakhs is to be credited. Credit means entry is what? Reverse the provision. Provision account debit to P&L 6 lakhs. Easy, huh? 2 marks it will come. Are you following, guys? 7 is done. 8 we have to do. I'll come back to 8 last. 9 over, guys. Let's do MCQ also. I'll come to 8 last. Different type of sum. We'll go in order and finish everything. Gratuity and pension would be examples of, quickly. You know the answer, guys. Post-employment benefits. Let me check. See. Next. Non-accumulating compensating absences. We studied in short-term benefits. Is commonly referred as non-accumulating compensating absence means paid leave which is not carried forward. So is it earned leave? No. Is it sick leave? No. Sick leave is different. Is it all of the above? What is left? Casual leave. That's the answer. Are you following, guys? Next. The plans that are established by legislation to cover all enterprises and operated by government includes multi-employer plans, state plans, insured benefits, employee benefit plan. In the book, I told you there are few types of plans in defined contribution. 2 types of funds. Controlled by themselves, trust. Non-controlled, multi-employer, state plan, insurance scheme. And I told you state plan means controlled by government, state or central government. Now come and answer this. If government is coming, operated by government means state plan. 3B, state plan. Guys, are you following, guys? Okay. Best estimate of the variable to determine eventual cost of post-employment benefit is. Okay, let's understand the question. Best estimate of variable to determine the eventual cost of post-employee benefit. I don't know what is the post-employee cost. You will ask employer, cost to company, employee, actuary. This whole standard is for actuary. Answer is actuary. Next. Actuarial gain and loss should be, just now we saw, the change in fair value should be 6 lakhs, charge immediately to P&L. Able to get the MCQ, guys? Okay. Then theory questions you will go through, guys. Why AS 15? What is the objective of the standard? To make inter difficult. CA inter difficult. But don't write that, guys. Okay. You write the 4 types of plans. Short term, post employee, termination, other long term. Okay. That's what they wrote. Okay. Next. Question 1 we have to do. This is regarding termination. So let me quickly go to the other 2 things. I told you once this gets over. Now we finished only A and B. But C and D is 2 minutes, guys. Okay. Quickly let me do that. Only 1 page. Look at this. Just be aware of the terms. In next 10 minutes I will close this chapter and that's it, guys. With me, easy or difficult, guys? That's it. After this nothing else is there new. Just closing points. With me first. Other long-term benefits includes long-term absence such as sabbatical leave. What is sabbatical leave? Be aware of what is other long-term benefits. What is sabbatical leave? You have been studying for inter for 1 year, 1.5 years. Suddenly you decided, I want 6 months break from everything. I want 6 months break. Then only I will come back. I am going to skip one attempt. 6 months you are taking break. Sabbatical. Somebody is working in a company for 5 years. After he resigns, Or when he is in work itself, he will tell, just give me a sabbatical. I want 6 months. I will go to Himalayas and come. I want some time for myself. That is called sabbatical leaves. Are you following, guys? Sometimes some companies, for sabbatical leaves, they will give you money. You take 6 months leave. You come back. I will pay you salary. For employees like Radharam, are you following? Key employees. Okay. Jubilee or other long-term service benefits. I told you, if you are in a company for 10 years, 25 years, silver jubilee celebration, golden jubilee celebration, you dedicated your life to the company. Come here, take a photo, take this shawl. Thank you so much. For that, you know it's going to happen, but it's happening after 12 months. Next. Long-term disability benefits. What is this? You worked in the company, we disabled you fully. No. Long-term disability benefits means if there's any for employees, family, all of that. No. Next. Profit sharing or deferred compensation paid 12 months or more than 12 months in which it is earned. Bonus paid for next 3 years, or bonus earned now but paid after 3 years, or bonus earned now, amortized and paid in 3 years. So what you earn now but spread over there. Are you following, guys? How to treat this? Same as post employee. That means same as DCO. Depends on where it falls. Same thing. Why? This is also long term. Correct? Future thing I have to discount. So discounting will come here in second and third. There is concept of discounting. So if this comes, go back to DCO and DBO. Mostly these things. If you have company has obligation, then benefit plan. No obligation in the future, contribution plan. Clear? Termination benefits. I already told you. Common example everybody will know is what? VRS. What is VRS? Full form, not full form, guys. Recording, come on. Why they'll do it? So what if employee retires voluntarily? Not like that. Appreciating. See, I'll tell you what is VRS. One bank employee is working in the bank as a manager for 20 years. Suddenly AI came. He has to lose his job now. But the bank is not in a position to fire him. Okay. So what they will tell, you itself, we will put a scheme, VRS. Those who retire now, we will give you a lump sum of 10 years, 10 lakhs. Take this money and go. So one lump sum payment given to you so that you retire. Are you following? It's like telling, let's say, KL Rahul, take 2 crores, don't play for India. Example, guys. Or let's say some player whom you don't want to play. Some player, guys, you don't want him to play. Give some money. I'm just giving example, guys. Fine. So instead of firing them and insulting them, give them money and ask them to resign for reasons. Okay. So here, look at this. Or if you are fired, I am firing you. So some compensation. Look at this. Termination benefits are paid where the employee is terminated, fired before his normal course of employment, or where employee leaves voluntarily. Accounting. Recognize liability by debiting P&L. However, if it's for more than 12 months, use appropriate discounting rate. That's it. Simple accounting. That's all in book. Some conditions. There should be detailed formal plan of sending amount. It should not be ad hoc. Reliable estimate can be made. But if you don't know how much you should pay, still computing, it becomes a contingent liability as per AS 29. That's it. Okay. These are the other two plans. Fairly simple. So with this, I'm just running through. This theory is done. This part also is done. What is defined benefit plan? I told you where risk is borne by the employer. Here I have just given in the book those who have whatever terms we discussed. Current service cost, past service cost, curtailment, benefits, change in actuarial estimates, actual return, expected return is mentioned. What is curtailment? Opposite of past service cost, meaning reduction in current service cost. Okay. Then here also we saw all dabbas. One last important dabba that we have here. In the balance sheet, let's say provision is 200, our planned asset is 600, or leave 600, let me keep it easy, 150. Instead of showing asset liability separately, you need to set off for presentation. Like how do you show debtors and provision? Do you show it separately or set off? Same logic here, you need to set off, guys. First I will write provision 200, I need to pay 200 less available asset is 150, shortfall is 50. You need to set off like this and show. Opposite means you have surplus. Okay. But if opposite is there, you will set off only to the extent it's available. Balance will be there in the asset side. Okay. That's it. So you will set off in both of this. Let's do the balance last two questions and close. Practical question 1. 2 we finished. 3 we finished. So we just have to do practical question 1 and inside 8th question and close the chapter. Nothing new to learn. 8th is important, but before that let's do this. A company has a scheme for repayment of settlement allowance to retiring employees. Under the scheme, retiring employees are entitled for reimbursement of certain travel expenses. Okay. For class they are entitled to as per company rule, and lump sum payment to cover expenses on food and stay during travel. They are saying travel expense we will reimburse. Alternatively, the employees can claim a lump sum amount equal to 1 month's pay. They are saying 1 month salary will give you, or based on how much you actually incur. Look at this, reimbursement of certain travel for certain class, food and stay. So bulka you take 10,000, or you incur expense, give me bill, I will reimburse. Okay. The company's contentions in this matter are settlement allowance does not depend upon the length of service of employee. What is settlement allowance here? They explain what is settlement allowance to retiring employees for travel. Once you retire, you have to go back to your hometown. Maybe it's for that kind of travel, for you to shift from the company and go back to your house, all of that. Settlement allowance does not depend upon length of service. It is restricted to employees eligibility for travel rule, or where lump sum is excised equal to the last pay. Since it's not related to length of service of employees, it is accounted on for claim basis. They're saying whenever somebody asks, you pass entry. Don't pass before they ask. You tell if it's correct or not. Should I pass entry after they ask, or I should estimate and pass before itself? Estimate and pass before itself, because I know they are going to ask. What's the answer? Look at this. Now this one, which four it will fall? Is it short term? No. Is it retirement? Could be retirement. After post retirement. So retirement or post retirement we classify into defined contribution and defined benefit. This will be in defined benefit because company has a obligation or liability. Look at this. Settlement allowance payable by the company is a defined retirement benefit plan. A provision should be made every year in the accounts accruing liability on subsequent allowance, just like that PUCM, projected unit credit method I will follow. Amount of provision should be calculated according to actuarial valuation. Actuarial valuation, if I go itself, PUCM method, because actuary uses PUCM. Where however the provision for should remain is not material, company can follow such other methods. That's it. Following, guys. Okay. Let's go to the last question. Mark that also as important. Question number 8. If you see so far, we have 3 types of questions, correct? One, we found that present value reverse working, current service cost and interest, 5,000, 6 lakhs, 8 lakhs. Then we saw this return on asset, actual or expected. We saw 2-3 sums, that compounding, that part. Now the third type of sum, in this only one sum is there. One of these 3 should be there in the question paper. Clear, guys? Last one, follow. This sum I will be exam oriented. Understand the point. Concept we have already done quickly. Rockstar Limited discontinues a business segment. Understand from that. Okay, they discontinued. Under the agreement with the employees union, the employees of the discontinued segment will earn no few further. That means they left before 5 years in that logic. Here it's not 5 years, but will they get gratuity now? No. That means if somebody is not going to get gratuity, the provision you made for that should be reversed. That's all the sum is about. Reverse the provision. This is a curtailment without settlement. Reduction of provision already made. Reduction of current service cost. I already told you what is curtailment. Correct? Guys, are you understanding? Okay. I know it's the last sum, but it's a new unique sum. Okay. Because employees will continue to receive benefits for services rendered before discontinuing of the business segment. They are trying to say only some part of benefit is reduced, they will still get some salary. Curtailment reduces the gross obligation for various reasons, including change in actuarial assumptions made before. Of course, if my current service cost is going to decrease, everything else will change accordingly for estimates. If the benefits, defined benefits, are determined based on last, they are saying how it's determined, like how we had 6 lakhs here, last drawn by employees, last salary. The gross obligation reduces after the, of course, the obligation balance sheet liability will reduce because last pay assumption is no more valid. Okay. Rockstar Limited estimates that share of unamortized service costs. That means what? Previous things I am accounting now, but I am amortizing for the future. That relates to the part of the obligation, rupees 18, 10% of 180. What is trying to say? Total unamortized is, I need to amortize 180, but in this 18 need not amortize anymore. Why? Those employees are leaving the business. Ideally, I would amortize 180 divided by number of years. Here I don't have to amortize in this 180, 18 because those employees are leaving. Sir, how do you know that? Look at this. Rockstar estimates the share of unamortized service cost that relates to the part of the obligation. Which obligation? That curtailed obligation. Calculate gain from curtailment, gain from reduction, and liability after curtailment to be recognized in the balance sheet of Rockstar given on the base information. Okay. Immediately before curtailment, the liability is, let me do it. Okay. So in balance sheet, visualize guys, apply sense. Okay. That liability provision was before curtailment. Fair value of asset is 5,000. Asset will come this side. 5,100. Correct? Easy. Unamortized past service cost is that they already gave on top. Unamortized is 180, but in this 180 you don't have to amortize. So what is left to be amortized? 160. Are you getting it, guys? I will repeat. Liability is 6,000. Asset is 5,100. Unamortized past service cost is 180. In that, no need to amortize 18. So balance left is 162. Super. Curtailment reduces the obligation by, which is 10% of the, so from 6,000, my liability has to reduce by 600. I am left with only 5,000. Now he is asking what? What is the question? Gain from curtailment. I want to know the net impact. How will I present this in balance sheet? First, from this 5,400, should I amortize the balance? 160 should amortize. Normally you will amortize. Now I should amortize. So minus, how much is left? 5,238. Are you following, guys? Now I will repeat. Look, listen carefully. My liability was 6,000, but now because of curtailment, liability is reduced by 600. So revised liability is 5,400. Now you need to amortize. Amortize means I have to add, correct? If you have to amortize, what's the entry for amortizing? Credit, prepaid, debit provision. Correct. We did correct only. So I have to reduce how much, guys? 162. It becomes 52. So let me again repeat. Liability was 6,000. It reduced by 600. Remaining is 5,400. In that I am amortizing, which 162. My balance liability is 5,238. Anything related to assets, reduction of assets? Nothing. So I should set off asset and liability. Reduce 5,000. So balance liability is I don't know if it's correct, guys. Balance liability 138. Let me go check. Yes, liability to be recognized is 138. Are you see the format they would have done is different. This you will understand. Liability finish off first, finish off assets, set off. For those who want to copy, here it is. Study mat. Same thing. What they did from 600 they reduced 18, kept 582. No, leave this method, guys. Understood this? Okay. Simple logical method. Gain from curtailment. Then if it's gain from curtailment, reduction in gross obligation is 600, but proportion of unamortized for that is 18. So that separate is 582. Because of curtailment, exact gain is 582. What is that? Liability reduced by 600, but unamortized reduces your liability, but that is reversing by 18. Opposite impact. So 582 is the net reduction. Then you have the same answer, 138. Perfect. Thank you for adding that question. With this, we are done with the question and done with complex accounting standard AS 15. Why I told complex? Wherever you see, everybody will tell, ayo, AS 15 now, difficult. So I also wanted to tell you it's difficult, then you will be serious in the start of the class. Yes, it's difficult in CA final. Okay, here we have very limited concepts. Anybody still feeling it's difficult? Anybody going to skip this? Then it's not difficult. Following, guys, scoring area. If you are thinking why they added this, now do you want this, guys? 3 types of sums, yes or no, it's there, guys. Okay, but it's not difficult. You have learned the concepts. That's about it. For those who didn't understand the concept, mug up the sums at least in book and go for exam and pass the exam. That is more important. Even after watching 3.5 hours, you didn't understand, fault is not yours. Fault is mine if you didn't understand. Recording students I'm talking. Okay, any doubts as usual you can WhatsApp me. Thank you, guys. With this, we conclude our last topic. Thank you. Okay. Thank you, guys.